This is David Trent Todeschini coming to you from the beautiful hills of southern North Carolina, bringing you the facts behind the news and the story that contradicts the mainstream media lies, hoping to convince you that the apparency of reality is in fact entirely fabricated and the illusion only appears to be true. But in the battle for the survival of the American Republic and Western civilization, we must expose these illusions in order to bring about and nurture a greater awakening that will preserve our God-given rights and freedoms, not only for ourselves, but for our progeny and for all the future generations of human souls on this planet. We not only must plant the trees whose shade we will never live long enough to enjoy, but first we must uproot the poisonous trees we have for so long been deceived into sitting under. We are dedicated to educate and inform and stand in the gap for all of those innocents who cannot fight for themselves. We have put on the armor of God and stand ready with the weapons of truth to put down the lies of tyranny wherever we find them. We are the watchmen of liberty. We don't forgive, we don't forget, we are invincible. We are American patriots. To this end, and with this firm resolve, my close associates and I have sworn the oath to protect and defend the Constitution of the United States and all Americans who share our values and wish to live free. Welcome to the most deleted, shadow banned, demonetized, censored, and trolled channel on social media. Recipient of the Patriot Warrior Purple Q Award. Silver price in China markets is over $90 US, while COMEX in the United States is around $80 US. Silver is about to explode as short sales scramble to cover their positions in a market that doesn't have the physical metal to cover the promissory paper. The 40-year-old Ponzi scheme ends when the Eastern markets open on Monday, or 6 p.m. Sunday Eastern. For over 40 years, the electronic paper market has been manipulating the price of silver by literally creating it out of thin air, in much the same way that governments all over the world have stolen the wealth of billions with paper money that is literally not worth a lit fart in a wool mitten. Those poor bastards who have paper short positions will be scrambling to meet their margin calls by either trying to buy long positions or physical silver. The demand either way will drive prices through the roof. Those who are holding the physical metal will see their investments exponentially increase in value. I can't advise you as to what to do, and there is always a risk that an investment will go sideways. I've been stacking silver for years, waiting for the inevitable day that is upon us. A 10% jump in silver price is, in my opinion, based on the data I've seen, is just the tip of the iceberg. Watch the two following videos and subscribe to those channels. Jump in before the big rush happens. Do it at the market open. Hello, this is Dave from N4T25 USA, Inglorious Patriots. It is December 27th, 2025, and the time now is 18:54 hours Eastern Time here in beautiful North Carolina. First of all, I want to apologize for not posting a Merry Christmas video. I hope you guys out there have had a very Merry Christmas. And for those of you who are owners of silver coins or silver bars or silver anything, you're about to have a very merry and happy New Year. Yesterday, I get in on the market very early, and I purchased a kilo bar of silver at about $78 an ounce. In the course of that day, the price jumped 10% to almost $80. In fact, it's 75 cents short of $80 right now as I speak on the COMEX. And it's waiting for the markets to open tomorrow afternoon at 6 p.m. That's Sunday, the 28th of December at 6 p.m. The Eastern markets will open. And right now, as I speak, silver is trading at $90 to $93 an ounce in China, in stores in China, where you can go in and, like a pawn shop, and buy bulk silver. So the COMEX price is definitely going to be $93 on the opening tomorrow here in the United States. And like these two videos before, mentioned before, that you're about to watch after me, you should subscribe to their channels because they are very informative. And if you listen to what they say, you're going to make a shit ton of money. I'm not a financial investor. I don't know what the fuck I'm talking about. But I made some money yesterday, and I'm fixing to make some money tomorrow too. But just remember this. Don't invest more than you can afford to lose. And with silver, I don't think you're going to lose anything. That's just my opinion. You can take it or leave it. But I'm telling you, if I was you, I'd get on your favorite metals brokerage account and set up your thing with your bank and your credit cards or whatever ready to go. And I'll leave some links down in the description for you. I don't make any money. I'm not a, what do you call it, affiliate of these guys, but I've done business with them before. You can tell them that Dave from N4T25 sent you, if you want to. I mean, it's not going to do anything for you, except you're going to get what you want to buy. And what you want to buy is silver as close to spot as possible. If you buy coins, those are collector's items. If you buy silver bars, that's a horse of a different color. And that's what I did yesterday. I bought silver bars. In fact, I bought 2 kilos of silver bars in separate transactions. So I'm not waiting for tomorrow to sell them. I'm waiting for July of 2026, when those 2 bars, those 2 kilos of silver will probably be worth $200 or $300 an ounce, if not more. The silver market has been suppressed ever since the Hunt brothers tried to take it over back in the 70s. And it's been a Ponzi scheme with paper ever since. They pulled the same shit back then that was exposed with the Gamestop stock short fiasco that happened. See, you got paper, and you call your broker and you say, sell 1,000 shares of GameStop at the market. So your broker gets on the thing and he sells the stock and you make the money. The money goes right into your account that day. That, in fact, within an hour. Now, if the price goes down, you made money because you got to buy that stock back. So you buy the stock back, and now it's $50 a share. You made $50 a share, and you didn't do nothing. You didn't have any money come out of your account. Nothing. Nothing happened with physical money. It's just your word. But if you got a short position, if the price goes up, you'll get a margin call. That means you got to make up the difference. You got to buy the stock to cover the difference between where you sold it and where the price is now. And if you can't meet that margin call, you lose your investment. The whole thing. And that's what a lot of people are stuck with right now in silver. They bought silver short positions that they were hoping the price would come down from a week ago, $77 an ounce, and it's now $93 in Shanghai. And when you're losing $23 an ounce, and when you're losing money, when you're losing over $20 an ounce, and you got tons of short sales out there, on paper, the people, that sold it for you, that put money in your account, want their silver back. They want the difference. They're going to call you and say, "Hey, you owe us," and if you don't pay, you lose. Well, on a short, you don't lose nothing, but you can get arrested. That's fraud. So anyway, it would behoove you to set up your accounts right now if you don't have a brokerage or a metals account, and wait for the market to open tomorrow afternoon at 6 o'clock. Sunday evening, 6 p.m. Eastern Time. The foreign markets will open. And if you watch the price there, it's going to be an indication of what's going to happen here. And I'll tell you right now, for the short sellers, it ain't going to be pretty. And for people who are holding pounds and kilos of silver, it's going to be one happy day. But you can't trade physical silver like you can with paper. But paper is a Ponzi scheme, just like Bitcoin. You're trading fiat money for what? For a promise of vaporware. You can make a lot of money doing it, and you can lose your ass. Because if you lose your password or your 12-word phrase on your account to log in, you're screwed. And Bitcoin and all the electronic currencies, as far as I'm concerned, are worse than the fiat paper. Because when you've got fiat paper and you log into your account and there's no money there, you can go down to the bank and say, "Where's my fucking money?" But if you're holding crypto and all of a sudden you can't log in, or you lost your password, or your phone got broke and that's the only way you had your thing, your account, you're fucked. You can't do nothing. You can't call up anybody. There's no phone number. Who are you going to go see? Satoshi? Buy silver. Take possession. Thank you for watching.
While you're watching this video, physical silver is trading near $90 per ounce in retail shops across China. Right now. Not theoretical, not projected. Actual transaction prices. But in the United States, on COMEX, the paper price is only $77.19. That's not normal. That's not market noise. That is a $12.81 gap between what physical silver actually costs and what paper contracts claim it is worth. This kind of disconnect doesn't just create trading opportunities, it triggers structural breaks in commodity markets. It forces repricing events. It exposes the gap between financial instruments and physical reality. And historically, when that gap gets this wide, something breaks. Either the paper price is forced to rise violently to meet physical reality, or physical silver simply disappears from availability as buyers hoard what they can get. In this comprehensive investigation, I'm going to show you exactly why there's a near $13 premium in Shanghai and what it means for COMEX as soon as Monday when markets reopen. I'm going to break down, one by one, where that premium comes from using real data from Chinese refineries and dealers. I'm going to explain why China, controlling 70% of global silver refining capacity, matters more than most analysts understand. I'll detail the new regulatory change taking effect on January 1st, 2026, that could completely reshape the global silver market by restricting exports. And I'm going to show you why this isn't just about China versus America, but about physical metal versus paper promises. What we're witnessing right now is the early stage of a narrative shift. For decades, COMEX set the global price of silver. What traded in New York was the reference, but that authority is cracking. Physical markets in Shanghai are asserting a different price. And when physical and paper diverge this far, history shows the paper market eventually capitulates. This is the story of how COMEX is losing the narrative, and why the gap you're seeing today is just the beginning. Today is Saturday, December 27th, 2025. And I need you to understand something critical before we go any further. I'm not talking theory, I'm not citing analyst reports or model projections. I'm talking real bars, real buying, and real shop pricing at Chinese dealers and refineries. This is ground level data, the kind that doesn't show up on Bloomberg terminals until weeks later, the kind that financial media ignores because it doesn't fit their narrative. But it's the most important data in the silver market right now, because this is where price discovery is actually happening. Let me give you the current numbers. Right now, the reference silver price in China is around 19.66 Chinese yuan per gram. Using the current exchange rate of approximately 7.05 yuan per US dollar, that works out to roughly $87.27 per troy ounce. That's the baseline. That's what the screen shows. But here's what you need to understand. Nobody sells physical silver at the screen price, not in China, not anywhere. In the real world, there's always an added premium. Why? Because physical metal has real costs, refining costs, fabrication costs, certification costs, logistics costs, and most importantly, the cost of immediate availability. When you buy paper silver on COMEX, you're buying a contract, a promise. There's no refining, no fabrication, no logistics. You click a button and you own exposure to silver price movements. But when you buy physical silver, someone had to mine it, ship it, refine it, fabricate it into bars, certify those bars, transport them to a dealer, and make them available for you to purchase. Every step costs money. And in China today, the minimum premium being charged above the screen price is about 1.50 yuan per gram. That doesn't sound like much, but let me show you what it means. In 1966, yuan per gram screen price plus a 1.50 yuan premium, the actual transaction price is 21.16 yuan per gram. Convert that to US dollars. 21.16 divided by 7.05 equals $3 per gram. Multiply by 31.1 grams per troy ounce. That's $93.31 per ounce. But wait, that's the retail asking price. The price dealers are selling at. What about the buying price? What happens when someone wants to sell physical silver back to a dealer? Interestingly, dealers in China are willing to pay approximately 1 yuan per gram above the screen price when buying. That's 20.66 yuan per gram. Convert that to dollars and it comes out to $91.65 per ounce. So we have a range. Dealers buy at approximately 91.65. They sell at approximately 93.31. The midpoint is roughly 92.50. For practical purposes, physical silver in China is trading in the $90 to $93 range right now. Meanwhile, COMEX shows 77.19. That's a gap of $13 to $16, depending on whether you use the dealer buy or sell price. Either way, it's massive. And here's what makes this critical. This isn't one dealer charging high prices. This is the market. This is how physical silver is priced across China's entire dealer network. And China isn't a small player. It's the center of global silver refining. When Chinese dealers are pricing physical silver $13 above COMEX, that's not noise. That's a signal. A signal that physical supply is tight, demand is strong, and the paper price is disconnected from reality. In this next part, we're going to break down exactly where that 1.50 yuan per gram premium comes from. Because understanding the components of that premium is critical to understanding why it exists and why it's not going away. Stay with me. We're going into the anatomy of the premium. If you're just joining us, we've established that physical silver is trading near $90 an ounce in China, while COMEX shows just over $77. That's a $13 gap. And we've shown the math using real dealer prices. Now we need to break down the premium. This is the part that confuses people who only watch financial screens and don't deal in physical metal. They see a $13 premium and think it's manipulation or greed. But when you understand the components, you realize it's just the cost of turning paper into metal. Let me walk you through it. The silver bars, widely sold in China, are produced by major refineries. Bars don't appear out of nowhere. There's a full industrial and logistics chain behind them. These are certified bars that meet purity standards, have serial numbers, and are recognized by the market. To manufacture these bars, the refinery has a direct cost of approximately 0.40 yuan per gram just for refining. What does that include? Energy costs for melting and purifying silver, labor costs for skilled workers, quality control for testing and certification, and processing, the physical work of turning raw silver into standardized bars. That 0.40 yuan per gram is not profit. That's the actual cost of refining. But before refining even begins, the refinery has to secure the raw material, raw silver feedstock. This comes in large plates weighing around 15.5 kilograms. They're the intermediate form, and here's where it gets interesting. Right now, traders are paying a premium of about 1.0 yuan per gram above the screen price just to secure that raw metal. Why? Because that's what it costs to actually get physical silver in hand. The screen price is theoretical. It's what silver might trade at if there were unlimited supply available instantly. But there isn't. And when multiple buyers want that limited supply, the price rises. That 1.0 yuan per gram premium is a pure market cost tied to the real availability of physical supply. So at this point, we can clearly map out the components. 1.1 yuan per gram to secure raw material from the market. 0.40 yuan per gram for refining and processing that material into bars. That's 1.40 yuan per gram in hard costs. But there's one more component. Dealers need a small profit to stay in business. This market is extremely competitive, so margins are thin. On average, dealers add around 0.10 yuan per gram as operating profit. That covers their business costs, rent, staff wages, insurance, and a small margin for the dealer. When you add those together, you get the real premium. 1.0 yuan to secure raw metal, 0.40 yuan for refining, and 0.10 yuan for dealer profit. The total equals 1.50 yuan per gram. That is the true, technically correct premium being applied on physical silver in China today. And notice what that means. Dealers are making only about 0.10 yuan per gram. In practical terms, on a 1 kilogram bar, the total profit is roughly 100 yuan. Convert that to dollars, and it's less than $15 profit on a bar worth over $2,800. That's a profit margin of half of 1%. Margins are tiny. Competition is brutal. Nobody can survive with big markups for long because if they try, another dealer undercuts them and takes all the business. This isn't greed, it's the cost of reality. Welcome to part 3. We've shown the $13 gap between physical silver in China and paper silver on COMEX. We've broken down the premium components to prove it's based on real costs, not manipulation. Now we need to address why this matters globally. Because some might say, okay, silver costs more in China, so what? That's a local market. It doesn't affect me. Wrong, dead wrong, and here's why. China accounts for roughly 70% of global silver refining capacity. And let me repeat that because it's critical. China refines 70% of the world's silver. That means a huge portion of the silver used worldwide, whether for investment bars, industrial applications, or jewelry, passes through China at some point in the supply chain. Even silver mined in Mexico, Peru, or Australia often gets shipped to China for refining. Why? Because China built the infrastructure. They have the refineries, the expertise, and the economies of scale. They can refine silver cheaper and faster than almost anyone else. For the last 2 decades, the West was happy with this arrangement. Mine the silver wherever it's found, ship it to China for processing, and China refines it into bars and sends it back. Everyone wins. Except that arrangement assumes China will always refine and export freely, and that assumption is about to be tested. Because here's the fact most people are ignoring. Starting on January 1st, 2026, silver exports from China will require special state licensing. This is not a rumor. This is not speculation. This is official policy. The Chinese government announced this regulatory change months ago, but markets are only beginning to price in the impact. What does special state licensing mean in practice? It means exporters need government approval to ship silver out of China. It means the government can control the volume of exports. It means they can prioritize domestic use over foreign buyers. It means they can restrict or even halt exports if they choose. Now, will they immediately ban all silver exports on January 1st? Probably not. That would be too disruptive. But they don't need to ban exports. They just need to slow them down, make them more difficult, add bureaucracy, add delays, add uncertainty, and suddenly international buyers who relied on Chinese refined silver have a problem. Because even if they can eventually get the metal, the timeline extends, the certainty decreases, and the cost increases. This is how export restrictions work. They don't kill trade overnight. They strangle it slowly. And during that strangulation, prices rise, premiums expand, and the countries controlling supply gain enormous leverage. Let me give you context on why China is doing this. China is the world's largest manufacturer. They produce electronics, solar panels, electric vehicles, batteries, semiconductors, and medical devices. All of these products require silver. So from China's perspective, why should they refine silver and export it when they need it domestically? Why send silver to America for American solar panels when China is installing massive solar capacity? Why export silver to Europe for European electronics when Chinese factories need it? The logic is simple. Secure domestic supply first. Export the surplus if there is one. This is resource nationalism, and it's accelerating globally. We've seen it with rare earth elements. China controls 90% of rare earth refining. They restricted exports, and prices exploded. Western countries scrambled to build alternative supply chains, but it took years. We've seen it with graphite. China dominates graphite processing. They tightened exports, and battery makers panicked. We're seeing it with gallium and germanium. China announced export controls, and prices jumped. Now it's silver's turn, and silver is more critical than most people realize, because silver is in everything. It's not just investment bars. It's in the solar panels that every country needs for net zero targets. It's in the EV batteries that every automaker is building. It's in the 5G infrastructure that governments are deploying. It's in the AI data centers that tech companies are constructing. It's in the defense systems that militaries depend on. Silver is a strategic metal, and the country that controls refining controls supply. So when Chinese dealers are pricing physical silver at $90, while COMEX shows $77, they're not just responding to local demand. They're pricing in future scarcity. They're pricing in the export restrictions coming January 1st. They're pricing in the reality that silver refined in China might stay in China. And if you're an international buyer and you want guaranteed supply, you have to pay the premium. Because the alternative is waiting, hoping, risking that you'll get metal later. And in industrial supply chains, hope is not a strategy. So buyers are paying $90. They're securing supply now, before the restrictions take effect, before availability tightens further. This creates a self-reinforcing loop. The more buyers pay premiums to secure supply, the higher premiums go. The higher premiums go, the more urgent other buyers become. The more urgent buyers become, the tighter supply gets. And the tighter supply gets, the wider the gap between physical and paper. We're watching this loop accelerate right now. In December 2024, the premium in China might have been $2 to $3 above COMEX. By mid-2025, it was $5 to $7. Now it's $13. That's not linear growth. That's exponential. That's panic. That's the market pricing in a future where physical silver becomes increasingly difficult to obtain. Now, let me address the arbitrage question. Because people always ask, if silver is $77 in New York and $90 in Shanghai, why don't traders just buy in New York and ship to Shanghai? Arbitrage should close the gap, right? In theory, yes. In practice, no. Here's why. First, shipping takes time, 3 to 4 weeks by sea. By the time your silver arrives in Shanghai, the premium might have changed. You're taking price risk. Second, you need to actually get physical silver from COMEX. That means taking delivery. And COMEX delivery is not as simple as clicking a button. You need approved vault storage, documentation, and you need to wait for the delivery process. It can take weeks. Third, once you have the silver in New York, you need to ship it internationally. That requires export documentation, insurance, security, and logistics coordination. More time, more cost, more risk. Fourth, when it arrives in China, you need import approval. And starting January 1st, that import might require the same state licensing that exports require. So the arbitrage that should close the gap is blocked by time, logistics, regulation, and risk. The gap persists because the friction is high. And because of that friction, physical and paper markets can diverge. And they are diverging violently. In Part 4, we're going to detail exactly what happens on January 1st when the new export rules take effect. Because that's the catalyst everyone's watching. That's the moment this premium could explode even wider. Stay with me. We're going into the regulatory shift that could reshape the entire global silver market. We've reached Part 4. We've shown the $13 gap. We've explained the premium structure. We've detailed China's dominance in refining. Now we need to talk about what happens in 5 days. On January the 1st, 2026, China's new export licensing requirement for silver takes effect. And markets are only beginning to understand what this means. Let me be very clear about what this regulation does. Currently, Chinese companies can export silver relatively freely. For a while now, standard export documentation, paying taxes, and shipping metal has been routine, bureaucratic, but straightforward. But starting January the 1st, that all changes. Exporters will now need special state licensing. This means before you can export silver from China, you need government approval. Not just paperwork, actual approval. The government has to say yes, and they can also say no, or they can say wait, or they can say yes, but only a certain amount. This gives the Chinese government direct control over all silver exports. In practice, this can mean several things. First, less silver leaving China. Even if the government doesn't explicitly restrict volumes, the extra bureaucracy alone slows everything down. Companies need to apply for licenses, wait for approval, and navigate new regulations. All of that takes time. And during that time, silver that would have been exported is sitting in China. Second, prioritization of domestic buyers. If the government has to approve exports, they can set conditions on that approval. They can say you can export, but only after domestic demand is met. This ensures Chinese manufacturers get the silver they need before it goes overseas. Third, leverage in trade negotiations. Export controls become a bargaining chip. If another country wants Chinese silver, they might have to make concessions somewhere else. Trade is never just about one commodity. It's about strategic relationships. Fourth, price control. If exports are restricted, international prices rise, while domestic prices stay lower. This gives Chinese manufacturers a huge economic advantage, since they get cheaper input costs, while their foreign competitors have to pay more. Now, some analysts are saying not to worry, that China won't actually restrict exports because they want the foreign currency from selling silver. That's a naive way of looking at it. Here's why. The value China gets from using silver domestically is far greater than the value of exporting it as a raw material. If Chinese factories use that silver to make solar panels, EVs, electronics, and semiconductors, they're creating finished goods worth 10 to 100 times the value of the raw silver. The real value is in manufacturing, not in selling raw materials. So economically, it makes much more sense to keep the silver in China and manufacture products than to export the silver and let other countries do the manufacturing. This is Industrial Policy 101. You keep the raw materials, export the finished goods, and capture all the value add. And that's exactly what China is already doing with rare earths, with graphite, and now, it seems, with silver. So what happens on January 1st? I expect we'll see immediate confusion. Some exporters won't have their licenses ready, some shipments will be delayed, and some buyers will panic. The premium for physical silver will widen. If the premium is $13 now, it could easily hit $15 or $18 by mid-January. International buyers who need silver will realize they can't count on Chinese supply anymore. They'll need to secure metal somewhere else. But there is no somewhere else at that scale. China controls 70% of the world's refining capacity. You can't replace that overnight. You can't just build new refineries in 6 months. It takes years. So in the short to medium term, international buyers have very limited options. They can pay the premium to get Chinese silver while they still can, or scramble to find alternative sources that are more expensive and less available. Either way, prices rise. And COMEX, which is pricing silver at $77, will be forced to acknowledge that physical metal is not available at that price. Maybe it does available at $85, maybe $90, or maybe it is not available at all in the quantities needed. When that becomes obvious, the paper price will gap up. Not smoothly, but violently. Because shorts will get caught, algorithms will detect the disconnect, and industrial buyers will flood the market with buy orders. This is the setup. January 1st is the catalyst. And the price gap we're seeing today is just the beginning. Now let's talk about the global implications, because this isn't just about silver prices. This is about entire supply chains. Every solar panel manufacturer outside of China relies on silver. Every EV battery maker, every electronics company, they all rely on silver. And if Chinese silver becomes restricted, those supply chains break. Companies will have to redesign products to use less silver, accept higher costs, or delay production. None of those are good options. This is why governments are starting to pay attention. This is why there are discussions about building refining capacity in the West. But those are just discussions for now. Actual refineries are years away. In the meantime, the market has to function with the capacity that exists. And that capacity is 70% in China. So China has massive leverage, and they're using it, not with aggressive threats, but with quiet regulatory changes that completely shift the balance of power. And the market is responding. Physical premiums are rising, buyers are scrambling to secure supply, and the gap between the physical and paper price is widening. Next, we need to talk about what happens when these paper markets are forced to acknowledge physical reality, because that moment is coming, and it won't be gentle. We've reached the conclusion. We've shown physical silver trading at $90 in China. We've broken down the premium structure. We've explained China's refining dominance and detailed the January 1st regulatory change. Now, we need to talk about what happens when paper meets physical. Right now, we essentially have two different markets. The paper market, represented by COMEX, pricing silver at $77.19, and the physical market, represented by dealers and refineries in China, pricing silver at $90. These two markets are supposed to be connected. Arbitrage is supposed to keep them aligned. But as we've shown, arbitrage is broken. The friction is too high, the timing is too long, and the risk is too great. So the markets are diverging. Historically, when this happens in commodity markets, the resolution is always the same. Physical wins, paper adjusts. Let me explain the mechanism. COMEX is a futures exchange. Most contracts are settled financially, not physically. Traders buy and sell contracts, and when they expire, they either roll to the next month or settle in cash. Only a tiny fraction, maybe 2 or 3%, result in actual physical delivery. The system works as long as everyone trusts that physical delivery is available if needed, and as long as the COMEX price roughly matches the price of physical metal. But when that gap gets too wide, trust breaks. Industrial buyers look at COMEX showing $77 and dealers charging $90, and they realize the COMEX price is a work of fiction. It's not the price at which they can actually get metal, so they stop using COMEX as a reference. They start pricing based on physical availability. And once that happens, COMEX loses its authority. It becomes irrelevant, a sideshow. The real price is determined in the physical market. We've seen this before. In 2022, nickel on the London Metal Exchange exploded 250% in 2 days. Why? Because a large short position couldn't deliver the physical metal. The paper market broke. In 2020, oil futures briefly went negative because there was no physical storage capacity. Chaos ensued. These are extreme examples, but they illustrate the principle. When paper and physical diverge, something breaks. And usually, it's the paper market that breaks, because physical is real. So the question isn't whether COMEX will adjust. The question is when and how violently. Based on current conditions, I expect the adjustment to happen soon, maybe in January as the export restrictions take full effect. Here's a likely sequence of events. First, industrial buyers who need physical silver start bidding aggressively on COMEX. They aren't speculating. They're trying to secure metal because Chinese supply is now uncertain. Their buying pushes COMEX from $77 to $80. Then, momentum traders see the move and pile in. Price hits $83. At $83, short sellers who sold at $75 or $77 start feeling the pain. They're underwater. Their brokers call for more margin. Some are forced to cover their positions, which means forced buying, pushing the price even higher. Price hits 85. Now the gap between COMEX and China is only $5. Arbitrage becomes viable again. Traders start buying on COMEX to take delivery and ship to China. This creates even more buying pressure on COMEX. Price hits $87. At this point, the narrative shifts. The media starts covering the story, silver hits new highs, and retail investors get FOMO and jump in. More buying. Price hits $90. Now COMEX and physical are aligned. The gap is closed. But did COMEX win? No, physical won. COMEX was dragged, kicking and screaming, up to meet physical reality. The paper market capitulated, and once COMEX is at $90, there's no reason it stops there. The fundamentals that drove physical to $90 are still in place. Chinese export restrictions, strong industrial demand, constrained supply. So the price continues higher, $92, $95, $98. This is how commodity repricing events unfold. They start slow, a gap appears. The gap widens, people dismiss it. Then suddenly the gap forces recognition, and the paper market gaps up to catch physical, and momentum carries it even higher. We're in the early stages of this process right now. The gap is $13. That's significant, but not yet a crisis. But if it hits $15 or $18 in January, crisis mode activates and the repricing accelerates. Just be aware, this information is for discussion and should not be taken as financial advice. If you're in the silver market right now, you absolutely need to understand what's coming next. This isn't just another fluctuation, it's a fundamental shift, and how you're positioned will determine whether you profit or get wiped out. Let's break it down based on your position. First, if you're long physical silver, meaning you own actual bars and coins, you're in the best possible spot. Your metal is real, it's yours, and you're perfectly positioned for the massive repricing that's on the horizon. The most important thing for you to do right now is just hold on. Don't get shaken out by the volatility that's inevitably coming. Don't fall into the trap of selling at $85 an ounce thinking you've hit the top, when the real target could easily be $100 or even higher. Your job is to have diamond hands and ride this out. Now, if you're trading paper silver, futures, options, ETFs, you need to be extremely careful. This is where the real danger lies. Leverage is a double-edged sword, and in this environment, it can destroy you. Imagine you're long with leverage and the price suddenly drops $5 in a single day. You could get stopped out, margin called, and lose your entire position just moments before the real, explosive move to the upside begins. You'll be left on the sidelines watching the rally you were waiting for. And if you're shorting silver right now, my advice is simple. Get out. Seriously. The risk reward is absolutely terrible. You might make a few dollars if the price dips temporarily. But if the price gaps up overnight, which is a very real possibility, you could lose everything. Shorts get completely destroyed in a supply-driven rally. It's like trying to stop a freight train with a feather. Don't be that person. Finally, what if you're on the sidelines waiting to buy? You have to understand that you might not get the deep pullback you're hoping for. The standard playbook says to wait for a dip, buy the correction, but we're not in a standard market. We're on the verge of a supply crisis. In these situations, any dip gets bought up almost instantly. The dip you are waiting for might be a $2 drop that lasts for all of 10 minutes. If you're sitting there with a buy order at $70, you're going to miss this entire move. You'll be left behind. Here's why. Let's look at the facts on the ground. Right now, as I'm recording this, physical silver is trading for $90 an ounce in China. Meanwhile, the COMEX paper price in the West is hovering around $77. That's a $13 gap, and this isn't some random anomaly. This gap exists for very real reasons. It's driven by premiums on raw materials, by soaring refining costs, and by dealer margins. It exists because China, which controls 70% of global silver refining, is about to restrict its exports. It exists because physical supply is incredibly tight while demand is incredibly strong. And most importantly, it exists because the paper market has become completely disconnected from physical reality. This gap has to close. It's not a matter of if, but when. And it won't close by the physical price coming down to meet the paper price. It will close by the paper price being forced violently upward to meet reality. The COMEX will be forced to acknowledge that $77 is a fantasy price. The only real price is what someone is willing to pay for an actual physical ounce of silver. And right now, that price is $90. Next week, it might be $95. By January, it could be $100. The trajectory is clear. The mechanism driving it is clear. The catalyst is clear. The only thing that isn't clear is the exact timing. We don't know if this gap will close next Monday, in 2 weeks, or in a month. But we know it will close. The laws of economics demand it. The raw power of supply and demand demands it. And when it finally happens, the repricing will be violent, it will be fast, and it will be incredibly profitable for those who are positioned correctly. This is why you need to subscribe to this channel. We are going to be tracking this situation in real time. We'll be monitoring the Chinese dealer prices, watching the COMEX, and we will report the second we see that gap start to narrow. We will document the moment the COMEX price gaps up, and we will explain exactly what it means for the next phase of this bull market. Because this isn't just about silver going from $77 to $90. This is about a structural, once-in-a-generation shift in who controls price discovery. For decades, the Western paper markets in London and New York have set the price for the entire world. Now, the physical markets in the East are asserting their authority. And whenever control of a market shifts, prices don't just move. They reprice to a whole new level. Not to where some Wall Street analyst thinks they should be, but to where the physical reality says they must be. When you see $90 silver in Chinese shops while the COMEX shows $77, that's not a bug in the system. That's a feature. It's a feature of a market transitioning from paper control to physical reality. And in that transition, fortunes are made and fortunes are lost. It's your job to make sure you're on the right side of that equation. If you want to keep tracking this incredible story as it unfolds in the global silver market, do me a favor, hit that like button, subscribe, and share this video with anyone you know who needs to hear this message. Thanks for watching, and I'll see you in the next update. April 5th, 1933. Most Americans woke up that morning thinking it was just another Wednesday. They had no idea that by the end of the day, owning gold would become a federal crime punishable by 10 years in prison and a fine equivalent to nearly $250,000 in today's money. No vote, no warning, just an executive order. And here's the part that should send chills down your spine if you own silver today. Because what happened to gold in 1933 happened to silver the very next year. Executive Order 684, August 9th, 1934. The government demanded Americans surrender their silver bullion to the United States Mint within 90 days. Same penalties, same coercion, same outcome. Now, I'm not here to tell you that the government has signed a confiscation order for 2026. That would be false and frankly irresponsible. But what I'm going to show you today is a historical pattern that every silver holder needs to understand. Because the mechanisms that made confiscation possible in the 1930s are being rebuilt right now, just in a completely different form. The next confiscation won't look like federal agents knocking on your door. It won't look like armed soldiers escorting you to the bank. The infrastructure being constructed today is far more elegant, far more efficient, and far harder to resist. Let me explain. In 1933, the United States was in the grip of the Great Depression. Real GDP had collapsed by 29% in just 4 years. Unemployment had exploded from about 4% in 1929 to 25% by 1933. 1 out of every 4 American workers had no job. Between 1930 and 1933, nearly 7,000 banks failed. That's roughly a third of the entire banking system. Gone. People were terrified. They were pulling their money out of banks and converting their paper dollars into gold because they no longer trusted the financial system. And here's the crucial detail. At that time, the dollar was backed by gold. The Federal Reserve Act of 1913 required 40% gold backing for every Federal Reserve note in circulation. So when people started hoarding gold, they were essentially draining the government's ability to print more money. The Federal Reserve couldn't expand the money supply because it didn't have enough gold to back it. The economy was strangling itself. This is why President Roosevelt issued Executive Order 61002. It wasn't really about punishing gold hoarders. It was about removing the constraint on money printing. By forcing citizens to exchange their gold for paper at $20.67 per ounce, the government could dramatically increase the gold reserves at the Federal Reserve. And then came the real betrayal. The Gold Reserve Act of 1934 immediately raised the official gold price from $28.67 to $35 per ounce. Citizens who had dutifully turned in their gold watched as the government effectively devalued the paper they received by nearly 70% overnight. The gold they surrendered was now worth 69% more, but they couldn't benefit from it. More than 2,600 metric tons of gold were collected. That's billions upon billions of dollars worth in today's prices. Now, here's where silver holders need to pay especially close attention, because most people who talk about the 1933 confiscation get a critical detail wrong. Executive Order 6102 was about gold. The silver confiscation came later, and it worked differently. Executive Order 68114, signed in August 1934, required the delivery of silver bullion to the government. But unlike gold, circulating silver coins were exempt. The government wasn't trying to take silver out of everyday commerce. They wanted the bullion, the bars, the stockpiles. Why? Because the Silver Purchase Act of 1934 had a specific goal: to increase silver to 25% of the combined value of gold and silver reserves. They needed raw material to mint more coins and back the currency. Here's the key number. Approximately 113 million ounces of silver were surrendered under that order. The government paid 50 cents per ounce, which was just slightly above market rates at the time. If you made a profit on that silver, you got hit with a 50% windfall tax. The entire operation was designed to funnel hard assets from private hands into government vaults, compensate citizens with paper promises, and then adjust the rules so those paper promises bought less than they did before. Sound familiar? Because that's exactly the playbook that concerns many financial observers today. Not a repeat of the 1930s in form, but in function. The mechanism changes. The outcome stays the same. Let me walk you through exactly how this played out, because the details matter. When Roosevelt declared a national emergency on March 3, 1933, just his third day in office, most Americans had no idea what was coming. Emergency powers give the president extraordinary authority under the Trading with the Enemy Act of 1917, as amended by the Emergency Banking Act of March 1933. Think about that for a moment. Legislation written during World War I to deal with foreign enemies was repurposed to deal with American citizens who simply wanted to protect their savings. Executive Order 6102 gave Americans less than a month to comply. The order was signed April 5th. All gold had to be delivered by May 1st. Violation meant up to 10 years in federal prison and a fine of $10,000, which adjusted for inflation is roughly $240,000 today. There were exceptions written into the order. You could keep up to $100 in gold coins, which translated to about 5 ounces. Rare and collectible coins with recognized special value were exempt. Gold used in industry, arts, and professions was also exempt if you had the proper license. But here's what they don't tell you in the history books. Enforcement was almost entirely dependent on voluntary compliance. The federal government didn't have the manpower to go door to door. They didn't have the resources to search every safe deposit box, every buried jar in the backyard. Frederick Barber Campbell was one of the few people actually prosecuted. He had over 5,000 ounces of gold on deposit at Chase National Bank. When he tried to withdraw it after the order was issued, the bank refused. Campbell sued the bank, and federal prosecutors immediately came after him. The irony? A judge threw out the initial prosecution because the president signed the order instead of the Treasury Secretary, as technically required. But the government still seized Campbell's gold. The authority to confiscate was upheld even as the specific prosecution failed. There was another case that made the papers. Louis Rufino, a resident of Sutter Creek, California, right in the heart of gold country. He was convicted of possessing 78 ounces of gold. His penalty, 6 months in jail, a $500 fine, and complete seizure of his gold. The message was clear. You might not get caught, but if you did, the consequences would be severe. Now, what's interesting is what happened next with silver. The government learned from the gold confiscation. They refined their approach. Executive Order 68114 came with the same threats. $10,000 fine, 10 years imprisonment. But the execution was more targeted. The Treasury Department actually compiled a list titled Hoarders of Silver before the order went into effect. It identified the largest COMEX silver traders and major bullion holders. If you owned less than 50,000 ounces, you weren't on that list. The government knew it couldn't chase down every small holder, so they focused on the big fish. This was efficient confiscation. Within the 90-day deadline, approximately 109 million ounces of silver flowed into the Treasury. Another 4 million trickled in before the order was eventually rescinded in 1938. But here's the detail that matters most for understanding the present. The Silver Purchase Act of 1934 included a 50% windfall profit tax on silver sales. This wasn't just confiscation. It was tax policy designed to make holding silver financially painful. You couldn't use your silver freely. You couldn't sell it at market rates without giving half the profit to the government. Your wealth was effectively frozen. This is the template that financial historians point to when they discuss modern wealth controls. Physical confiscation is messy, unpopular, and difficult to enforce. Taxation is clean, legal, and almost impossible to evade if the financial system is properly structured. The Silver Purchase Act eventually expired on December 31st, 1937. By then, the government had what it needed. The monetary system had been restructured. Private precious metal holdings had been significantly reduced. And the precedent had been set. In times of declared emergency, your property rights are negotiable. Here's something most people don't realize. Gold ownership remained illegal for American citizens until December 31st, 1974. That's 41 years, during which you could go to prison for owning more than a trivial amount of gold. It took an act of Congress under President Ford to restore the right that had existed since the founding of the nation. Those 41 years weren't an accident. They were the time needed to fully transition away from commodity-backed money. By 1971, the Nixon shock had ended any remaining link between the dollar and gold. By 1974, it didn't matter anymore if citizens owned gold. The monetary system no longer depended on it. And that's the key insight for understanding what might come next. The government doesn't confiscate assets for fun. They do it when those assets threaten the system they're trying to build or protect. Now let's talk about what's happening right now, because the numbers are almost incomprehensible. As of December 2025, the United States national debt stands at approximately $38.4 trillion. I want you to really sit with that number for a second. $38 trillion. That's $112,000 for every single person in America. That's nearly $285,000 per household, and it's growing at a rate of roughly $6.1 billion per day. That's $255 million per hour. That's $4.25 million per minute. Every single second that passes while you're watching this video, the national debt increases by roughly $71,000. Just 5 years ago, in 2020, the debt was $27 trillion. We've added $11 trillion in half a decade. In fiscal year 2025 alone, the debt increased by $2.2 trillion. But here's what really matters: the interest payments. In fiscal year 2025, the United States paid approximately $981 billion in net interest on the national debt. That's nearly $1 trillion just to service existing debt. 5 years ago, that number was $345 billion. We're now paying almost 3 times as much in interest as we were paying during the COVID pandemic year. And the Congressional Budget Office projects that interest payments as a share of total government spending will rise to nearly 14% in 2026 and keep climbing from there. For context, interest payments now exceed what we spend on Medicare. They exceed what we spend on national defense. We are spending more money on interest than on protecting the country or caring for the elderly. This is not sustainable. Everyone knows this. The math doesn't work. The federal debt now exceeds 122% of the entire gross domestic product. That means we owe more than the total value of everything produced in America in an entire year. This is approaching levels not seen since World War II, when we were fighting an existential conflict on 2 fronts. So what does this have to do with silver? Everything. In 1933, the government faced a crisis where gold hoarding was preventing them from expanding the money supply to fight the Depression. The solution was to seize private gold and remove the constraint. Today, the constraint is different, but the principle is the same. The government needs flexibility to manage this debt situation. They need to be able to print money, adjust interest rates, and control capital flows without obstruction. Physical precious metals represent an alternative. They're wealth that exists outside the banking system, wealth that can't be inflated away, wealth that can't be easily tracked, taxed, or controlled. Now, I want to be very clear about something. I'm not predicting that the government will issue an executive order demanding you turn in your silver. That specific scenario is unlikely for several reasons. First, gold and silver are no longer part of the monetary system. The government doesn't need your metal to back the currency because the currency isn't backed by metal. Second, the political backlash would be enormous. We live in a different era with different communication tools. An old-fashioned confiscation order would go viral within minutes and create massive resistance. Third, and most importantly, there are far more elegant solutions available today. Solutions that achieve the same outcome without the political cost. This is where we need to talk about the future of money, and specifically, what's being built right now in terms of digital currency infrastructure. But before we get there, let me share something that most people overlook. The government already has mechanisms to discourage precious metal ownership without ever touching confiscation. Capital gains taxes on precious metals are treated differently than other investments. When you sell silver at a profit, it's taxed as a collectible at a maximum rate of 28%, not the 15 or 20% long-term rate that applies to stocks. That's already a penalty built into the system. And here's what concerns some analysts. In a fiscal emergency, the 28% could become 40%, or 50%, or more. No confiscation needed, just taxation. The IRS already requires dealers to report certain transactions. Form 1099 to Report B gets filed when you sell more than 25 ounces of gold maple leafs, for example. The infrastructure for tracking is already in place. It just hasn't been fully utilized. This is the direction that worries careful observers of monetary policy. Not the dramatic seizure, but the quiet tightening of the regulatory environment until holding precious metals becomes financially impractical for most people. In July 2023, the Federal Reserve launched FedNow. This is an instant payment system that allows banks and credit unions to transfer funds in real time, 24 hours a day, 7 days a week. Now, I want to be precise here because there's a lot of confusion on this topic. FedNow is not a central bank digital currency. The Federal Reserve has explicitly stated this. FedNow is a payment rail, an infrastructure layer that moves existing dollars between financial institutions faster. However, FedNow is the kind of infrastructure that could support a CBDC if one were ever created. It demonstrates the capability to process instant, traceable digital transactions at a national scale. As of 2025, 137 countries and currency unions, representing 98% of global GDP, are actively exploring central bank digital currencies. There are currently 49 CBDC pilot programs running around the world. 3 countries, the Bahamas, Jamaica, and Nigeria, have fully launched digital currencies. China is the furthest along among major economies. They've created over 2.25 billion digital wallets for their ECNY, and they're using it in both domestic transactions and cross-border pilots through something called mBridge. In January 2025, an executive order was issued prohibiting federal agencies from undertaking any action to establish, issue, or promote a CBDC, and directing agencies to terminate any plans related to its creation. This effectively paused any movement toward a retail digital dollar in the United States. But here's what I want you to understand. The technological capability exists. The infrastructure is being built globally. And policy positions can change with new administrations. The question isn't whether a CBDC is coming tomorrow. The question is what happens to physical precious metals if and when any form of programmable money becomes dominant. Let me paint a picture. And remember, this is a thought exercise based on historical patterns and technological capabilities, not a prediction. Imagine a scenario where some future administration decides that to combat tax evasion, money laundering, or financial crimes, all transactions above a certain threshold must be conducted through authorized digital channels. This wouldn't be unprecedented. Many countries already have limits on cash transactions. In such a scenario, your silver doesn't get confiscated. Nobody shows up at your door. But when you try to sell that silver to pay your property taxes or buy a car, you discover that the buyer can only pay you through a system that reports the transaction automatically. Maybe that transaction triggers a notification. Maybe it requires additional documentation. Maybe there's a special tax applied to precious metal sales that didn't exist before. Your silver is still yours, but its utility as a wealth preservation tool has been significantly diminished. This is what I call digital encirclement. You don't ban the thing. You don't confiscate the thing. You just make it progressively harder to use the thing in the normal economy. History offers precedents for this approach. Remember the 50% windfall tax on silver profits in 1934? That wasn't confiscation. That was making it economically irrational to hold and sell silver. You got to keep your metal, technically. You just couldn't benefit from it properly. Some financial observers have speculated about scenarios where precious metals could be subjected to special windfall or wealth taxes during times of fiscal crisis. An 80% tax on capital gains from precious metals would make selling extremely painful, essentially trapping your wealth in a form the government would prefer you didn't hold. Again, your silver isn't confiscated. It's taxed into irrelevance. This is why understanding the 1930s matters so much. The playbook isn't always about the dramatic seizure. Sometimes it's about creating conditions where holding becomes costly and selling becomes punitive. Now, let's be fair and examine the other side of this analysis, because there are real, practical reasons why a 1930s-style confiscation is much less likely today. First, the sheer logistics. In 1933, gold was concentrated. Most Americans didn't have significant gold holdings. The gold that mattered was in bank vaults, safe deposit boxes, and a relatively small number of private collections. The government could target banks, require them to report holdings, and apply pressure through formal financial channels. Today, precious metals ownership is dispersed among millions of individual holders. There are dozens of major online dealers, countless local coin shops, person-to-person transactions that leave no paper trail, international storage options, cryptocurrency purchases of metals, the infrastructure for tracking and seizing is exponentially more complex. Second, constitutional resistance. The Fourth Amendment protects against unreasonable searches and seizures. And while the Supreme Court upheld the gold confiscation in the 1930s under emergency powers, we're in a different legal environment today. Any confiscation attempt would face immediate legal challenges, and the current Supreme Court has shown willingness to limit executive overreach. Third, political reality. Precious metals holders tend to be highly engaged voters. They tend to be organized. They tend to make a lot of noise. Any administration attempting a confiscation would face fierce political opposition and would likely pay a severe electoral price. Fourth, the international dimension. In 1933, there was nowhere for your gold to go. Today, you can legally store precious metals in vaults in Singapore, Switzerland, Canada, Australia, and dozens of other jurisdictions. Confiscating domestic holdings would simply accelerate capital flight. Fifth, and perhaps most importantly, enforcement. The federal government is massive but not omniscient. During the 1930s confiscation, compliance was estimated at roughly 60 to 70%. That means a third to 40% of Americans simply ignored the order and faced no consequences. They buried their gold, hid it, passed it to family members, or otherwise refused to comply. The government knew about this noncompliance and could do very little about it. They didn't have the resources to investigate every household. Tom Woods, the historian, documented that the gold confiscation fundamentally depended on voluntary compliance. People turned in their gold because they trusted the government's assurances, not because agents forced them. Today, trust in government institutions is at historic lows. Any confiscation order would be met with mass non-compliance from day one. So what's the realistic scenario? In my analysis, it's not seizure. It's encirclement through reporting requirements, taxation, and transaction restrictions. Step one might be enhanced reporting. Dealers might be required to report all transactions above a certain threshold, currently $10,000 for cash transactions. That threshold could be lowered. The definition of reportable transactions could be expanded. Step two might be capital gains treatment. Physical precious metals are already taxed as collectibles at a maximum rate of 28%, which is higher than the 20% rate for most other long-term capital gains. This disparity could be increased. Step three might be transaction taxes. A special tax on precious metal sales, similar to the 50% windfall tax of 1934, could be implemented during a declared fiscal emergency. Step four might be digital currency requirements. As digital payment systems become more prevalent, requirements that certain transactions occur only through those systems would effectively marginalize physical precious metals. None of these steps require confiscation. They just progressively reduce the utility and attractiveness of holding physical metal. This is the sophisticated approach, the one that doesn't create martyrs or generate viral resistance videos, the one that slowly, quietly makes precious metals holders question whether it's worth the hassle. Let me tell you why silver holders are in a unique position within all of this. Gold gets all the attention. It's the traditional store of value. It's what central banks hold in their reserves. When people talk about precious metals confiscation, they almost always mean gold, but silver has characteristics that make it fundamentally different. First, silver is an industrial metal. More than half of global silver demand comes from industrial applications, not investment. Solar panels alone now consume approximately 17% of total silver demand, up from less than 6% in 2015. Consumer electronics, medical devices, water purification, 5G networks, electric vehicles, all of these require silver. A government attempting to restrict silver would simultaneously be restricting industrial supply chains. That creates powerful corporate lobbying against any such measures. Second, silver is affordable. At current prices, around $66 to $67 per ounce, silver remains accessible to average retail investors. A single ounce of gold costs well over $4,000. This means silver ownership is far more dispersed among ordinary citizens. Confiscating silver would affect far more voters than confiscating gold. Third, silver has a dual nature. It functions as both an industrial commodity and a monetary metal. This ambiguity provides some protection. Is your silver bullion an investment or an industrial raw material you're holding for a future project? The line is blurry, which makes regulation more difficult. Fourth, silver's physical characteristics favor the holder. Silver is bulkier than gold by value. $1 million worth of gold fits in a shoebox. $1 million worth of silver requires significantly more space. This might seem like a disadvantage, but it actually makes silver harder to concentrate and easier to distribute among multiple locations. Now, let's talk about what's happening in the silver market right now, because the fundamentals are extraordinary. Silver has been in a structural supply deficit since 2021. That means global demand has exceeded global supply for 5 consecutive years. The cumulative shortfall from 2021 through 2025 totals almost 800 million ounces. That's equivalent to roughly 10 months of global mine production that simply doesn't exist anymore. Global silver mine production reached approximately 820 million ounces in 2024, up slightly from the previous year. But demand continues to outpace this supply. The electrical and electronics sector, which includes solar photovoltaics, consumer electronics, and automotive components, has increased silver consumption by 51% since 2016. This isn't speculation. This is fundamental supply-demand economics. There's less silver available above ground than there was 5 years ago, and demand is accelerating. Silver prices reflect this reality. After spending most of 2024 consolidating between $28 and $34 per ounce, silver broke out in 2025. At various points this year, silver has traded well above $60 per ounce, reaching new multi-decade highs. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged between 50.1 and 61. At various points in recent years, this ratio has exceeded 81 or even 91, suggesting silver remains historically undervalued relative to gold. When precious metals enter bull markets, silver historically moves faster and further than gold. The smaller market size amplifies price movements. The combination of investment demand and industrial demand creates multiple buying pressures. Some market analysts have pointed to targets of $100 per ounce or higher in the coming years, though it's important to note that price predictions in commodity markets are notoriously difficult and should be viewed with appropriate skepticism. What's not speculation is this. Russia became the first central bank in modern history to explicitly accumulate silver reserves with a reported $535 million purchasing program. When governments start accumulating silver, it signals something about their view of its future monetary value. Let me add some more context about the supply side. Silver mining is often a byproduct of other mining operations. Roughly 70% of silver production comes from mines primarily focused on gold, copper, lead, and zinc. This means silver supply can't easily respond to price increases. If silver doubles, mine operators can't simply double production because silver isn't their primary focus. New mine development takes 10 to 15 years from discovery to production. Even if silver prices encouraged massive new exploration today, meaningful new supply wouldn't reach the market until the mid-2030s or later. Meanwhile, demand keeps growing. The photovoltaic industry alone is projected to consume increasing amounts of silver as solar installation continues to expand globally. China increased its solar capacity by 45% in 2024 alone. India is ramping up. The European Union has aggressive renewable targets. All of this requires silver. There's also the above-ground inventory question. Unlike gold, where almost all gold ever mined still exists in some form, silver gets consumed. Industrial applications destroy silver at a molecular level. It disperses into electronics, medical equipment, and industrial processes, becoming economically unrecoverable. The Silver Institute estimates that since 2019, more than 1.1 billion ounces have been drawn from available mobile inventory. That's silver that was accessible and has now either been consumed or locked into investment products like ETFs, where it's held but not available for industrial use. This creates a situation some describe as a slow-motion supply crisis. Not a dramatic shortage that makes headlines, but a persistent tightening that supports prices over time. So where does this leave you if you own silver or are considering ownership? First, understand what you're doing and why. Physical silver is not a get-rich-quick scheme. It's not a trading vehicle. It's a form of wealth preservation that exists outside the traditional financial system. It has value because humans have valued it for 5,000 years, across every civilization, through every type of government and economic system. Silver doesn't produce dividends. It doesn't generate interest. It doesn't grow earnings. What it does is maintain purchasing power over very long time horizons while remaining physically in your possession. Second, understand the legal landscape. Right now in the United States, owning physical silver is completely legal. There are no restrictions on how much you can buy, hold, or sell. This is different from the situation that existed from 1934 to 1938 for silver bullion. When you sell silver, you're required to pay capital gains taxes on any profit. As mentioned, collectibles like precious metals are taxed at a maximum rate of 28% for long-term gains. This is higher than the rate for most investments, but is the current legal reality. Dealers are required to report certain transactions to the IRS, particularly when you sell specific quantities of certain products. Understanding these reporting thresholds helps you make informed decisions about how you structure your holdings. Third, consider geographic diversification. The advantage of the modern era is that you're not limited to domestic storage. International vaulting services in jurisdictions like Switzerland, Singapore, and the Cayman Islands offer legal options for storing precious metals outside your home country. This isn't about evading taxes or breaking laws. It's about reducing single country risk. If you're concerned about any future domestic policy changes, having some portion of your wealth in a different legal jurisdiction provides optionality. Of course, you're still required to report foreign holdings if they exceed certain thresholds. This is about legal diversification, not evasion. Fourth, consider form diversification. Not all silver is created equal from a strategic perspective. Government-issued coins like American Silver Eagles, Canadian Maple Leafs, and Austrian Philharmonics carry sovereign status. They're recognized worldwide, have guaranteed purity, and in some jurisdictions, receive preferential tax treatment. Private mint rounds and bars are typically available at lower premiums over spot price, giving you more ounces for your dollars. They're less recognizable but equally valuable as pure metal. Constitutional silver, meaning pre-1965 U.S. coins with 90% silver content, carries an interesting historical footnote. These coins were explicitly exempted from the 1934 silver confiscation. While past exemptions don't guarantee future protection, some holders view junk silver as carrying historical precedent for regulatory leniency. Fifth, understand that silver is a long-term strategy. Precious metals go through cycles. There will be periods where the price declines significantly. There will be times when your silver holdings look like terrible investments compared to stocks or real estate. The point isn't to maximize short-term returns. The point is to maintain a portion of wealth in a form that cannot be debased by central bank policy, cannot be frozen by a bank, and doesn't depend on any institution keeping its promises. Sixth, privacy considerations. While not advocating anything illegal, it's worth noting that private party transactions in most states don't require reporting below certain thresholds. Building relationships with local dealers, attending coin shows, and participating in collector communities creates options for future transactions that may offer more flexibility than dealing exclusively with large online platforms. All of this should be done within the bounds of tax law. But understanding the full landscape of options is part of being a sophisticated holder. Seventh, dollar cost averaging. Because precious metals can be volatile, many holders prefer to buy consistently over time rather than making large purchases at single price points. This smooths out the entry price and removes the emotional stress of trying to time the market. Eighth, documentation. Keep records of when you purchased, what you paid, and what form the silver takes. This documentation protects you when calculating capital gains, taxes upon sale, and provides proof of ownership if questions ever arise. Ninth, estate planning. Silver and other physical assets need to be properly addressed in estate planning documents. Your heirs should know what exists, where it's stored, and how to access it. Undocumented precious metals can create significant problems for estates. 10th, balance. Physical precious metals should be part of a diversified portfolio, not the entirety of it. Most financial advisors suggest allocations of 5 to 15% in precious metals, depending on your risk tolerance and time horizon. This isn't financial advice, just an observation of common professional guidance. The goal isn't to bet everything on silver. The goal is to have a meaningful allocation to an asset class that behaves differently than stocks, bonds, and real estate. When traditional financial assets decline, precious metals often move in the opposite direction. This negative correlation provides portfolio protection during crisis periods. I want to zoom out and give you some historical perspective on why precious metals have maintained value, while every paper currency in history has eventually failed. The Roman denarius started as nearly pure silver during the Roman Republic. By the time of the empire's collapse, it had been debased to less than 5% silver content. Emperors discovered they could fund their spending by reducing the metal content of coins, paying soldiers and suppliers with increasingly worthless money. This always ends the same way. Eventually, people catch on. Prices rise to compensate for the debased currency. Economic activity distorts around the worthless money. And ultimately, the system collapses or is replaced. The French assignat of the 1790s was one of the first paper currencies to hyperinflate into worthlessness. The Weimar German mark of the 1920s became so worthless that people burned stacks of bills for heat because they were worth less than firewood. The Zimbabwe dollar, the Venezuelan bolivar, the Argentine peso, the pattern repeats across centuries and continents. The US dollar has lost approximately 96% of its purchasing power since the Federal Reserve was established in 1913. What cost $1 then costs roughly $30 now. $1 saved in 1913 and kept as cash would buy a small fraction of what it once could. Meanwhile, gold priced at $20.67 per ounce in 1913 now trades well above $4,000 per ounce in 2025. Silver, priced around $0.60 per ounce in 1913, now trades around $66 to $67. This isn't coincidence. It's the mathematical result of currency debasement versus monetary metals that cannot be printed. Now, does this mean silver will always go up? Absolutely not. Silver crashed from nearly $50 in 2011 to below $14 in 2015. It spent years in the doldrums. Precious metals can be volatile and unpredictable in the short term, but over long horizons, the pattern is clear. Governments spend more than they collect. They make up the difference by creating new currency. That new currency dilutes the value of existing currency. And hard assets, things that cannot be printed, maintain their real value against that debasement. This is why precious metals have served as stores of value throughout history, not because of mystical properties, because of mathematical ones. The current fiscal situation of the United States, with debt at $38 trillion and growing by $6 billion per day, with interest payments approaching $1 trillion annually, with no political consensus on reducing spending or increasing taxes, suggests that significant currency debasement is likely in the years ahead. This doesn't mean the dollar is going to crash tomorrow. The U.S. maintains the world's reserve currency status, and there's no obvious alternative waiting in the wings. But the trajectory is concerning to many economists and financial observers across the political spectrum. In this environment, holding some portion of wealth and assets that exist outside the fiat currency system is not crazy. It's prudent. It's what wealthy families, sovereign wealth funds, and central banks do. The difference is that central banks hold gold. Individual citizens hold silver because it's accessible at normal income levels. Let me share one more historical observation that rarely gets mentioned. After the 1933 gold confiscation, enforcement was sporadic and often politically motivated. The government couldn't possibly track down every gold holder. What they could do was make examples of a few high-profile cases to encourage compliance. Frederick Barber Campbell's case made headlines precisely because the government wanted it to. The message was, we might not catch everyone, but if we catch you, the consequences will be severe. This selective enforcement has implications for how future wealth controls might work. The government doesn't need to catch everyone. They need to catch enough people to create fear. They need to make the cost of noncompliance potentially devastating even if the probability is low. This is why some precious metals holders focus on privacy. Not because they're doing anything illegal, but because maintaining a lower profile reduces the probability of becoming an example. Consider also the psychological impact of the 1930s confiscation on subsequent generations. Many Americans who lived through that era never fully trusted the banking system again. They kept cash under mattresses, bought real estate, and avoided financial instruments controlled by institutions that had betrayed them. This generational distrust took decades to fade, and arguably, it never fully disappeared. The precious metals community today includes many people whose grandparents or great-grandparents were directly affected by the confiscation orders. The memory persists through families. Will that memory protect future generations? It might. Or it might simply make them more creative targets. Only time will tell. So let's bring this all together. The confiscation orders of 1933 and 1934 were responses to a specific crisis, a Depression-era economy strangled by gold standard constraints that required the government to have gold backing for its currency. That specific situation no longer exists. The dollar isn't backed by gold or silver. The government doesn't need your metal to print more money. It can create unlimited dollars digitally whenever it chooses. This means a direct 1930s-style confiscation order is unlikely. The costs would exceed the benefits, the political backlash would be severe, the enforcement would be impossible. But the lesson of history isn't just about the specific mechanism, it's about the pattern. When governments face fiscal emergencies, they look for wealth to capture. In the 1930s, that meant seizing gold and silver. In modern times, it more likely means increasing taxes, expanding reporting requirements, restricting transaction methods, and using technology to close escape routes. The threat to silver holders isn't a knock on the door at midnight. It's the gradual construction of systems that make holding and using precious metals progressively more difficult. The threat is a CBDC that becomes the only legal way to pay taxes or receive government benefits. The threat is reporting requirements that make every transaction visible. The threat is windfall taxes that capture the majority of any gains. The threat is an economy so fully digitized that physical money becomes a curiosity rather than a currency. Will these things happen? I don't know. Nobody does. But the infrastructure for them is being built. The technology exists. The fiscal pressures are real. And the historical pattern of governments capturing private wealth during crises is as old as government itself. So what should you do with this information? If you own silver, understand why you own it. Not as a speculation on price, not as a trading vehicle, but as a form of wealth that exists in physical form, in your possession or stored securely by your instruction outside the digital financial system. If you're considering silver, do your own research. Understand the tax implications in your jurisdiction. Understand the storage challenges. Understand that this is a long-term strategy, not a short-term trade. And regardless of what you decide about precious metals, understand that the monetary system you grew up with is changing. Digital currencies, central bank experiments, the ongoing debasement of fiat money, these are not fringe concerns. They're mainstream developments covered daily in financial media. The 1933 confiscation order wasn't announced in advance. Citizens woke up one morning and discovered the rules had changed overnight. Their gold, which they had legally acquired and legally held, was suddenly contraband. Those who had prepared, who had thought ahead, who had diversified, were in a better position than those who hadn't. History doesn't repeat, but it often rhymes. The melody from the 1930s may be playing again, just in a different key. Silver trading around $66 to $67 per ounce today represents a form of insurance. Insurance against currency debasement. Insurance against financial system failures. Insurance against policy changes that could affect conventional assets. Is it the right insurance for you? That's a decision only you can make. But now you understand the history, you understand the present, and you understand the range of possibilities the future might hold. Let me leave you with a few questions to consider. What percentage of your wealth exists in physical form that you directly control? Not a number in a bank account, not a stock certificate held by a broker, but actual tangible assets in your possession or stored under your direct instruction. If your bank account were frozen tomorrow, how would you pay your bills? This isn't a paranoid fantasy. Bank freezes happen regularly in countries experiencing financial crises. They happened in Greece in 2015. They happened in Cyprus in 2013. They happen whenever governments decide that controlling capital flows matters more than individual convenience. If the rules changed overnight, as they did in 1933, are you positioned to adapt? Or would you be caught completely unprepared, like the Americans, who woke up to discover their legal gold was suddenly contraband? These aren't pleasant questions to consider. Most people prefer not to think about worst-case scenarios. But the Americans who were prepared in 1933, who had thought ahead, who had diversified, who had stored some wealth outside the system, those were the ones who came through intact. The specific risk might be different today. The exact mechanism might be different. But the principle remains. Systems that seem permanent can change rapidly when pressured. Rules that seem fixed can be rewritten when convenient. And wealth that exists only as numbers in someone else's computer is wealth that exists only at their pleasure. Physical silver, sitting in your safe or a secure vault under your name, is not subject to someone else's permission. It doesn't require a network connection. It doesn't depend on a bank staying solvent. It doesn't care what the government's fiscal situation looks like. It's just metal, real, tangible, eternal metal that humans have valued for 5,000 years and will likely value for 5,000 more. Maybe that's worth something in your portfolio. Maybe it's worth a lot. If you found this analysis valuable, subscribe. Share this with someone who holds silver or who's thinking about it. Because understanding this history isn't just academic. It could be the difference between being prepared and being caught off guard. And drop a comment below. I want to know, are you holding physical silver? If so, for how long? And what's your strategy for the years ahead? What lessons from the 1930s do you think apply today? And which ones are historical artifacts that no longer matter? The community that watches this channel is one of the most informed, most thoughtful groups of investors I've encountered. Your perspectives matter. Your experiences matter. And together we can understand this landscape better than any of us could alone. Remember, the goal isn't fear. The goal is preparation. The goal is understanding. The goal is being positioned intelligently for whatever comes, whether that's continued prosperity or unexpected challenges, because in the end, the people who do best in any financial environment are the ones who thought ahead, who considered possibilities, who didn't assume that today's rules would be tomorrow's rules. Be one of those people. Until next time.
Ever since the Great Awakening, thousands of content creators like myself have been burning the midnight oil well into the wee hours of the morning, and millions of us who are awake are not getting enough sleep. Everyone knows that a good night's sleep is essential for efficient functioning of the cognitive processes that enable a person to discern truth from fiction and deep state-induced woke dementia. Well, years before I was asked to be an advertiser for My Pillow, I have been using their products. The first product I used was, of course, the pillows. I was impressed with the comfort, and I was able to fall off to sleep almost immediately rather than having to fight a bag of foam and trying to get comfortable. The pillowcases and Giza sheets are absolutely the bee's knees, and I have sets for the 2 beds I have in my home. Another thing is their body pillow. I suffer from a lumbar spine injury that is exacerbated by my preference to sleep on my side. Having the body pillow to roll onto alleviates the pressure and mitigates the discomfort, allowing me to fall asleep quickly. Mike Lindell, a great American patriot, has an entire line of quality products that everyone should try. Once you sleep with the pillows and sheets, you'll throw the ones you have in the garbage or donate them to Goodwill. If you go to www.mypillow.com, there is a link in the description. As a viewer and subscriber to this channel, you can buy anything in the store for 66% off. That's 1/3 of the retail price. Just fill your shopping cart and use promo code N4T at the checkout. Take it from me, folks, I've been using Mike Lindell's products since 2015. There is nothing like them on the market, and I say this with 71 years of sleeping experience. Don't forget, use promo code N4T at checkout.